Most real estate investors focus on buying. The smart ones focus on what happens when they sell. Today's episode is a preview of a conversation every investor needs to hear before their next move. It's a sit down with Johnny Chandler and Eric Bradshaw, two 1031 exchange intermediaries who have seen firsthand how small decisions around taxes and timing can cost or save hundreds of thousands of dollars. In this conversation, we're breaking down the rules investors misunderstand, the mistakes that quietly kill 1031 exchanges, and the scenarios where tax strategy should absolutely influence your next deal. This is not advice for you to Google after the fact. This is the thinking that happens before smart investors pull the trigger. I'm interviewing Eric Bradshaw and Johnny Chandler next Tuesday at GRID Charleston Live. It is a live event that we do every month on the third Tuesday of the month. Each month we have a different speaker that comes along and talks about their specific expertise in relation to real estate investors in the Charleston area. I want to take a moment to thank our sponsors, Coastal Equity Group, Seagrass Capital, Tide Property Management Co., Matt O'Neill Real Estate, Mitchum Law Firm, Coastal Creative Media. Thank you guys for making this event free for everyone. We will hold GRID next Tuesday at 1349 Old Georgetown Road in Mount Pleasant, South Carolina. The doors will open at 5:30 and the event will start promptly at 6:00 p.m. Look forward to having you there. Okay, so let me ask, I'll go to Eric first and then Johnny. I just want to hear brief, 30 seconds to a minute. How did you get started in this? Why did you find out that, 1031 exchanges was your passion? And where have you found yourself adding, like a ton of value to real estate investors and people who are doing these types of transactions?
Well, I've been a real estate attorney with a tax background for 25 years. And so I've been doing 1031 exchanges pretty much for that entire time. So I've watched it kind of develop as an area of law. And of course, in Charleston, there was ripe opportunity for a lot of people to take advantage of it. And so began to specialize it. And there weren't a lot of other locals trying to do that as well. So for forever and ever, just been doing it and now do it pretty much exclusively.
Awesome. How about you, Johnny?
Yeah, so mine was a little bit different, right? I became friends with Eric first, and then he, saw my attention to detail and my enthusiasm and passion, and then also a need to offer the service, to his law firm clients. So to make sure we kept all of that above, and arm's length, and I came in to assist there, and then we've taken it on full time because it is great to offer solutions to folks when they say, "Hey, how can I do this? How can you help me out?"
Yeah, awesome. How many 1031 exchanges do you think you guys have done over the course of your career?
Thousands.
Okay, so you've seen thousands of 1031 exchanges. What is the most common mistake investors make with 1031?
Mistake, I wouldn't call it a mistake per se. I think one of the hardest hurdles to clear in the context of a 1031 is identifying potential replacement properties within what's known as an identification period, which is only 45 days from the closing on their sale. A lot of people underestimate just how difficult it is to zero in on a property that they are extremely confident they're going to end up buying. Because a lot of times even if they find a property, if they get it under contract, they still have to go through their inspections and who knows what might be lurking beneath the surface there that might disqualify that property as a viable replacement property in the exchange. So a lot of people, I think, underestimate exactly how short of a time period a month and a half is. And so I think chance favors those who are prepared, and people that start their investigatory process of replacement properties prior to even the closing on the sale end up better than not.
So start early, start research early is what I'm hearing.
Yep. And then from my perspective, instead of mistake, I'm going to say misunderstandings, kind of what valuations are being used for the 1031 and looking at that, growing our value. We'll say sales price to sales price or gross to gross. So that's definitely a misunderstanding even amongst real estate professionals of how to handle that when they're trying to be prepared and looking around.
Sales price is sales price or gross to gross. Can you just explain that to me?
A lot of people get under the impression that all they have to do is reinvest the net, or all they have to do is reinvest their gain, or all they have to do is reinvest some figure other than the gross amount of the sale price. So the concept of the 1031 exchange is that if you sell $1 million property, the IRS would like to see that you're reinvested in another but different $1 million property or more. And so a lot of people are like, oh, well, it's $1 million property, but I bought it for $300,000. I only need to find a $700,000 property. And that's just not the case. You really ought to be going for equal or greater value when you're exchanging. You can do it for less, but then we're looking at a partial exchange, and then there's probably going to be some capital gain tax triggered, even if you are shielding the lion's share of it through the 1031 exchange. You should anticipate some tax being owed if you don't buy for equal or greater value.
Gotcha. Okay. So you can still buy, right? It doesn't negate the whole thing. It's just a partial
Absolutely.
1031.
You can do partial exchanges. We do them all day long.
Is there something that investors do or people do during these transactions that accidentally disqualifies an exchange? Have you ever had it to where it's like, I don't know, it's like a
Very
week before
common
closing?
because we are very hands-on insofar as guiding them through and navigating these waters. So generally speaking, as long as they listen to us, we're going to steer them clear of all of these pitfalls. So as a general rule, no, I don't see things happen where someone goes off the reservation and disqualifies their exchange.
Gotcha. What's something people should do to prepare for a 1031 exchange if they currently own the property and they're thinking about selling and they're thinking about moving the proceeds into another one? What's something that, they should
They
do
should
on the
reach
back
out to
end?
their CPA and have them crunch the numbers and double check to make sure that it makes sense.
Is there a threshold of where it, like minimum where it doesn't make sense?
Well, generally speaking, as long as the taxes exceed $3,000, they're going to be saving money doing it.
Gotcha.
Yeah, my perspective is find a good CPA if you already have it and have that relationship so you've got to phone a friend early and often.
Gotcha. What are some general questions or things that people should be asking about 1031 exchanges when they're considering it early on?
Most people just want to know how they work.
Yeah. I mean, again, it's going back to deadlines. Those are calendar days. Those are real days, not just business days. What do you need from me is always probably a good question. Obviously, as much information early on makes everything better because that way we're in the know and can, guide them through, just like Eric said. So,
Now, 1031 exchange is one vehicle, right? I know there's multiple vehicles. Can you guys describe to me some other types of vehicles that people use?
Oh, there's some cost segregation, accelerated depreciation analysis. There's loss carry forwards if they got them. There are some obscure things insofar as 1033s and whatnot when you're talking about properties that may have been seized in condemnation or things like that, which will help with tax liability. They don't come up very often. They're very rare. But yeah, I would say that those are the lion's share of things.
How do reverse 1031 exchanges work?
Reverse exchanges are simply changing the chronologies. Instead of a forward exchange where you sell first and buy second, you're doing it in the opposite order. You're going to find a property that you just have to buy before your other one sells. You purchase it first, and then you'll sell your relinquished property within the 180-day deadline as it would be in a forward exchange. The trick with a reverse exchange is that there is no money that's held by a qualified intermediary. So in a forward exchange, the rule of thumb is you can't touch the money. If you touch the money, it's taxable in your hands. Therefore, a qualified intermediary holds that money for you. In a reverse exchange, the simple rule of thumb is you cannot hold title to both properties at any given moment in time. So either the property that you're buying, which is 95% of the time the case, or the property you'll ultimately sell has to be temporarily vested with essentially the qualified intermediary through a newly formed LLC, for the duration of the exchange. So basically until the property you're selling sells and closes.
So when you're buying the new property, are you like getting a loan on it, like doing all the normal things you would do in buying the property?
It happens a lot. People do get financing for them. We also see a lot where people have the money to buy it in cash.
Gotcha. That's fascinating to me. What about a reverse 1031 exchange? I'm sure that there's more expenses or less expenses. I don't know. Is it like the same threshold of where it makes sense as a normal 1031 exchange?
No, a reverse exchange is generally speaking 3 times as expensive as a forward exchange. So it's far more complicated. And far more involved insofar as paperwork and logistics. And obviously, it's a lot simpler to hold money in an escrow account for a client than it is to hold title to property, which has its own complexities of insurance and who's named as an additional named insured, interfacing with the closing team so that they can wrap their head around this complexity that the property is being bought by somebody but may not be titled in that person's name for a period of time. And it's a lot of work.
But I will say this, Paul, that, as far as the buying up, rule of thumb we talked about, that is still the same. So hopefully you got a decent idea of what you're looking to sell, or, maybe selling multiple properties to buy this new hot, desirable property, which is why a lot of people do reverse and go ahead and buy that new property first because they just found it and got to have it.
Yeah. Yeah. It's got to be a really killer deal is what I'm hearing. Right. Eric, the very first transaction that we worked on was a guy bought like a warehouse and it was fully entitled for 2 additional warehouses. And he did a 1031 exchange and he built the 2 warehouses within that. He used basically his funds to build the warehouses that were fully entitled. Is that I guess, can you walk me through, I've never heard of that before, but you got it done.
It's one of the 3 main varieties of 1031 exchange. This one can be called either a built-to-suit exchange, a construction exchange, or something along those lines. A rose by any other name still smells as sweet. It just has a bunch of different names. But basically, we'll use construction or an improvement exchange as a good way of describing that. And so it is a little bit of a hybrid between a forward exchange, because you're selling first and buying second, and a reverse exchange, because one of the rules with an improvement exchange is that the client cannot hold title to that replacement property he's buying during the period improvements are going to be erected on the property using 1031 funds. So again, we're back to qualified intermediary has to have a single purpose LLC for purposes of holding temporarily the title to that replacement property while doling out the remaining exchange funds towards those capital improvements within the 180 days. So on a improvement exchange, obviously, if people want them to be successful, as close as you can time the sale and the purchase together will maximize the available remaining 180 days to get those capital improvements done. Those are challenging, to say the least, because, you really would need to have a head start on your permits and whatnot. Yeah. And here, at least in Charleston County, permits can take months, and there goes a big chunk of your available time to build these capital improvements and try to use up that extra 1030.
Yeah. Yeah, I remember this was fully entitled. It was ready to go with permits in hand, and we were.
Yeah, and that is the way to get it done.
Yeah. Wow. Okay. Tell me so this event is next Tuesday. We're going to be talking about 1031 exchanges and tax advantage strategies. What do you think, for the audience who come, who are real estate investors, what's one thing that they will leave this event with, something, a valuable piece of knowledge?
Greater understanding of 1031 exchanges is a valuable tool for them to get the deals done that they want to get done.
That's right. That's right.
Yeah.
Pretty simple.
I think the Q&A, every transaction is a snowflake, even if there's not a 1031 involved. So understanding, kind of what their common misconceptions might be, and then what their common transactions look like and how it fits into the footprint of a 1031.